Welcome everyone to July 2023 monthly market update with Clear Vista Financial, also known as Clear Vista Perspectives. I'm Jesse Hamilton and I'm joined as always by Mark Trice.
Hey folks, it's been an interesting month
Yes,
and we've seen some positive signs in the market. The economy's got some mixed signals and things, Jesse, but we will cover all those in today's program. And always, we're recording this so that you can listen to it a little bit later on. So thanks for joining us and we'll jump right in.
So here's our agenda for today. We're going to look at the month of June performance for all of our major indexes. We'll take a look at some market commentary, talk about the economy, what's new, what the Fed's doing last month and what they might do this month. And as always, if you have any questions at all, send them to info@Clear Vista Financial, or you can text 254-282-0495. We would love to hear from you.
Yeah, that's our compliance texting phone.
Yes,
so
it is.
Or you can send messages there anytime and we'll get back to you as quickly as possible on those things.
Right.
So,
well, I want to cut the camera real quick so everybody has a little more real estate to work with, but let's start it off with the S&P 500. It rose for the first 2 weeks of June and it peaked on the 16th. You can see our chart here, our candle chart. That red candle right in the middle is the peak. The index was 6.47% in the month. Pretty strong performance there. And then, it peaked on the 16th and fell 2.69%. And then it did close just barely above that June 16th high. Overall, this is a positive trend for the index. We did notice a shift in the third week of June where the small caps and the mid caps started turning around a little bit. We'll talk about that in just a moment. Not necessarily outperforming the large caps, but we'll continue to watch this trend.
So some positive signs this month.
Yes. So next we'll look at the NASDAQ, which is our tech-heavy index. This index has been fueled year to date, Mark, so far by those 6 or 7 companies, the mega cap companies. We'll discuss in a moment how this trend could be changing. It might not be, but the index was plus 6.59 for the month. It also peaked on June 16th and then fell 3.81%. And this index actually did not close above the June 16th high. You'll see on the chart that last green candle on the last trading day is not higher than the peak.
Okay, still a good month.
Yeah.
How about the Russell 2000?
So the Russell 2000 was very interesting and volatile during the month of June. It showed strength for the first 2 weeks, but then it fell back again after June 14th. We'll talk about what happened on that day in a little bit. We have not seen this index behave like this since the beginning of the year, though. So improving small cap index could mean more breadth in the market. We don't know for sure yet. And of course, it was up 7.77%.
Okay.
Just for perspective, we showed a slide a few months ago about how the largest company in the S&P 500 is actually bigger than the entire Russell 2000. Isn't that unbelievable?
Yeah, and it just, but for a healthy recovery in the stock market, you need that breadth of all companies rising, and we're not quite seeing that yet. In fact, Jesse hasn't alluded to this yet, but all these indexes that we're showing you are rolling over again here the first week of July as we're doing this recording.
Right.
So still remain to be seen what exactly is going to happen, but positive signs from the month of June.
Yes. And the last thing we'll look at is the long-term Treasury bond index. It was flat during the month. It did rise nearly 1% and fall as much as 2.9%, but the month was filled with indecision. So take example, the red candle right in the middle of the chart, like directly in the center. This is what we call a doji candle, which comes from the Japanese phrase that means the same thing. So it means the price fluctuated throughout the day, but it closed right where it opened.
And there was a reason for that, Jesse. It wasn't, right. I mean, it's interesting. I didn't know that was the term for doji and what that meant. So thanks for the little tidbit. We can use that at our next barbecue.
Sure. But the traders basically couldn't make up their mind.
And that's the same day. That's the same day of the Fed meeting, actually.
Exactly. So it provides little information as far as the trend of the index, although some experts might consider that bearish.
Yeah. And when we've seen the long-term treasury index continue to fall the first part of this month, that's probably anticipation of rising interest rates, which we will get to in just a moment.
Right. So we alluded to this, and we actually showed this chart last month. But to see breadth in the market, we want to see big and small companies doing well at the same time, right?
That's right. And so what Jesse's prepared here in this slide, the green and red line is the S&P 500 index. The blue line is the Russell 2000 index. And this goes back about 6 months, but what you're seeing there is a divergence of the two lines. And when we see that, we're seeing that the small cap part of the market is not performing as well as the large cap. Now, if we were to extend this timeline over to the first week of July, we're seeing that is markedly dropping off with the small cap. So we need to see these two lines come together to show breadth in the market. But we're just not quite seeing that yet. A lot of positive signs this month, but still not seeing that type of breadth that we're looking for.
Right. So our next slide here is the S&P 500 price channel. Mark, you want to cover that one?
Yeah, and I put this in here because I wanted to show people that yes, the S&P is rising, but it's rising and kind of up and down within a price channel. And I think this is a positive sign that price channel keeps trending up. But until we break out to the top side of that, we're not going to see the ability for the broad market to break out to new highs.
Right.
And this is important because we still are. I mean, the news and the media is reporting that we're in a new bull market, and technically we are in a new bull market, but we're nowhere near the highs of January 2022 or the late fall of 2021. And so we expect this to be choppy, kind of going up and down within this rising price channel. But the fact that this price channel is trending up is a very positive sign.
Right.
Okay. And this is coming off the October 22 lows. October 2022 was the low in the market.
So this is a chart that we include sometimes, just comparing growth stocks versus value stocks, just comparing the indexes themselves. When the line is trending down, when it's trending up, that means that growth is doing better. And as you can see, 2023 starts in the middle of the chart, and the line has been trending up, which shows that growth is still winning over value.
Yeah, and that's a question we get a lot about value stocks, growth stocks. Right now, growth stocks tend to be outperforming value. This is a relative comparison. This is not a recommendation for anything.
Right.
But let's jump into the economic update and what we see kind of happening here. Just as a reminder, you can text your questions to 254-282-0495 or email us at info@clearvistafinancial.com. These are places for us to answer your questions. We'll get back to you shortly on those things.
Right.
But, there's lots of questions still out there, a lot of unanswered questions about the economy. And we want to try to dissect this a little bit and try to take some of the scariness of the headlines out of as we talk to investors, but investors seem to be ignoring the potential peril.
Yeah, that's been the trending article title in the last couple of weeks is what's happening? There's all this looming peril, but why? What's really happening?
Well, there's an old saying, Jesse, that the stock market will climb a wall of worry.
Okay.
And there's plenty of things for us to worry about as financial advisors, but there's not a lot of things we can control.
Right.
And so we're going to take apart different pieces of this economic sector and talk about those things, what the Fed's doing, how does that impact your portfolio and things, and take that apart. Let's jump in real quick, though, with really the yield curve. And once again, this is the yield curve on June 30th. You can see on the left-hand side of the chart is the interest rate of those treasuries, and the
T-bills, the short ones.
T-bills, and also the 10, 20, and 30-year treasuries. The x-axis here is the type of T-bill or treasury bond that's out there. One of the things that we looked at, it's still inverted. And this inversion started in March of 2022. Now, this is well beyond this curve of a year. We're seeing this happen. And we discussed last month about the inverted yield curve as a precursor to a recession. And I told you before that normally we see shorter term T-bills and treasuries lower in interest rates than long-term T-bills or long-term treasuries. And we're still seeing that the 30-year treasury is somewhere between 3.8 and 4%. This was as of the end of June. That actually is higher now. But what we're seeing here is the short-term T-bills, the 1 month, 2 month, 3 month, are paying now above 5% in yield. And that 5 month yield is around 5.5%, if you will. While the 30-year treasury is around 3.8. Now, this is important because I want to show you the next slide I'm going to put up here is actually the beginning of the year. And what you're seeing is a steepening of the yields on the very short T-bills. That means, and that's why you're starting to see CD rates go up to north of 4%. You're starting to see savings accounts maybe creep up a little bit at certain credit unions or banks. And this is causing a problem. And the reason for that is the Treasury is having to refinance the U.S. government debt of renewing treasuries at these higher rates. And also with the lifting of the debt ceiling, Jesse,
right?
That is a big thing. Between the middle of 1st of June through the end of the summer, we anticipate that the Treasury is going to issue over $1 trillion in new bonds. That's new debt to the federal government. What this is going to do is take, and we'll probably touch this later on, it's going to take money supply out of our money supply in the economy, and it's going to cause interest rates to go up even higher. And we've seen that over the last month with those short-term T-bills rising in interest rates. Now, not bad if you're a saver, right? But we know inflation is higher than that right now. This is still, we still predict that the U.S. will go into a mild recession at some point.
Exactly.
Let's move along here.
So this next chart just compares the 2-year versus the 10-year. You'll see the yellow line is the 2-year and the gray line is the 10-year. Generally, the 10-year Treasury is going to be important to determine auto loans, mortgage consumers, that kind of consumers that are actually using the debt. But the high 2-year Treasury means, like you said, Mark, that a lot of banks and credit unions are paying some pretty good CD rates on short term.
That's right. But normally, Jesse, the 10-year is above the 2-year yield.
Right.
This is why this is important, because it is kind of a conundrum that we don't like to see this, because it usually means economic headwinds for the economy.
So these rates are heavily influenced by the Federal Reserve's interest rate decisions. So let's move to the next slide and we'll see what they did in June.
So in the June 14th meeting, we were watching this very closely. The Fed didn't change the overnight Fed funds rate.
For the first time in quite a while.
Oh yeah, and the market rejoiced because there was a pause, right? And the meeting before in May, there was a big deal. We were watching it and so forth, and the chairman, Jerome Powell, tried his best not to say the word pause or anything that meant pause, because he didn't want markets to overreact. Well, he paused. And it was unanimous, apparently, that they are going to pause rates. But the Fed minutes came out this last week, and we found that of the regional bank presidents and on the Federal Reserve, they wasn't so unanimous, as far as there were a number of people that wanted to raise interest rates in June. But the big thing that the Chairman Powell told us in his press conference was they're prepared to raise rates this month in July. The meeting is toward the end of the month, if the economy and inflation don't cool down more. We're going to talk about inflation a little bit more. But there are new economic projections they released on Wednesday after their two-day policy meeting. They produced the minutes about a month later. Strongly suggested, those minutes said they were leaning towards slowing down their increases rather than stopping them altogether. So I don't know what that means for July. There is anticipation that there are at least 2 more interest rate hikes penciled in this year, and that would lift them to a 22-year high.
Right.
But they also at the same time boosted their expectations for growth and inflation. We think this is going to cause inflation to go up. You'll see a small horizontal line on here. This is a chart representing the pause over on the right-hand side of the slide there. They're not raising them. They didn't raise them in June. So that was positive, but it could be premature.
Mm-hmm.
So, and there was an article just released actually yesterday that talked more about how some Fed officials wanted to raise them again in June. And so we think the market is pricing in an expectations of another increase here at the end of the month. And I think there'll be another one throughout the year. So we do see that. But this is just to give you some context, because this chart shows the current rate cycle, which is in black, the current rate cycle versus other major rate changes over the past few decades. And you'll see the light blue line here in 1989 was at the end of the 80s. This shows how aggressive this path has been for us. This is almost like a hockey stick type line, the black line, for how fast the Fed raised interest rates. And this is very dramatic because this is causing the economy to contract very quickly.
Right. This is the fastest, most aggressive hike you can see on the comparison chart there that we've ever had.
Well, look at the red line, guys. So let me show you the red line here, because this is very interesting. This only goes back to the mid 80s, but you can see here in the early 80s, the red line where they actually started cutting interest rates. Everyone probably remembers that time frame. Maybe not you, Jesse, but most of us remember that time frame where rates were very high, and Paul Volcker cut interest rates too quickly. And you can see that he had to raise them during the mid 80s very rapidly. This is what the Fed's trying to avoid. They don't want to be too premature with their rate cuts, but they're also they're trying very hard not to kill the economy. But, there's some key takeaways that we read from that Fed minutes last time, and they are on the screen here, but they've had some success in bringing down inflation.
Yeah, we'll cover that in just a second.
Yeah, as far as raw materials, factory gate prices, and so forth. But they've failed to bring down consumer prices in any meaningful way. The core CPI, consumer price index, is still stuck above 5%.
That's the one that really affects the average American.
Yeah, and so, but you've got corporations that are still signaling they intend to raise prices even more. There are few indications that the economy is going to collapse, but that may be the only thing that actually brings inflation down.
Right.
So, and we expect those prices to rise again. What's propping up the economy, Jesse? It's consumer spending, right?
Right.
Yeah, and we still have excess savings of about $533 billion from the COVID stimulus.
Right, and this is mostly with excluding lower and middle income citizens, because they've probably had to spend it.
Yeah, that's right. We are seeing a rise in consumer debt.
Yeah,
amongst the lower and middle income economics classes and so forth. So the savings are coming down, and when those savings are exhausted, I think that's when you'll see the real impact on the economy.
Yep. So I saw this article this morning, Mark, and I thought it was interesting. As if we needed more industry buzzwords, here's 2 more for you: greedflation and wageflation. So greedflation is the ability of companies to raise their prices to keep profits high. We just covered that as a key point.
I don't know why they call it greedflation, because a company is in business to make profits for their shareholders.
It exists to make money for the shareholders.
Right. And so we kind of have this attitude, and at least in the media, that we are going to condemn corporations for making a profit.
Yet we own all their stock.
Yeah. And so, it's a conundrum and conflict of interest, I think, but that's the terminology that's being thrown out there.
Right. But we presented on this several times last year, and you'll see the chart to the right, just for comparison of the history of it. But companies have maintained such high profit margins because they were jacking up their prices. The article called it a seller's paradise.
You gave the example of General Motors, right?
Right. They actually sold fewer cars in 2022 than 2019, yet they made 50% more profit.
Okay. All right. So, let's not condemn the corporations, but I think those corporations will keep passing on those costs directly to consumers.
Right. So like we said, the consumer cash might begin to dwindle, but
okay,
we'll see what happens.
All right. So let's talk a little about housing, because this has been one that we thought was going to be impacted negatively because of rising interest rates. And yes, housing sales have slowed, but we're also seeing housing starts increasing because I think builders are anticipating for the future. And so they're both getting, many Americans are getting priced out, but let's talk a little bit more about housing starts, okay? Housing starts increased 21.7% in May to a 1.631 million annual rate, and that beat consensus expectation of 1.4 million starts. And this is up about 5.7% versus a year ago. Now, that gain was due to both single-family and multi-unit starts. In the past year, though, single-family starts are down about 6.6%, while multi-unit starts are up 33%. And that's a reason where you tend to build more apartments when people can't afford houses.
Right. That's why we're seeing such dramatic difference.
Yeah. And this is just a 1-month trend, but housing starts are at the highest level since the previous peak in April of 2022, before those mortgage rates really began to surge. So we're seeing that maybe pushing through the economy, the interest, people are absorbing the higher interest rates. Those 30-year mortgages continue to hover around 7%, but I joke with Jesse because he'd never seen 7% as an adult. And I'm like, my first mortgage was around 10, So it's all relative. I mean, it's certainly more expensive to finance a home at 7% than it is at 3%. But that's making it tough for also existing homeowners. But hopefully you don't have an adjustable rate mortgage, because I think you're going to get a surprise here at the end of that financing term. So anyway,
but look how different it is for existing home sales.
Yeah. We expect this to be choppy for some time as the mortgage rates for existing home sales are really having an impact. If you assume a 20% down payment on a typical home, the rise in mortgage rates since the Federal Reserve began its tightening cycle in March of 2022 amounts to about a 32% increase in monthly payments. And that's just on the median price home and so forth. So, but while financing costs remain a burden, the good news for prospective buyers is that the median prices have started falling as well. Sellers are not in the driver's seat anymore, and that's going to help push down prices and hopefully boost future sales.
Right.
But, it's going to be hard for an existing homeowner that wants to sell their home to accept the fact that they might not be able to get as much money as they thought they were going to be able to get in the past.
Right.
Because the market is not as hot. So, let's give an example, Jesse, of a typical home.
Sure.
And how that impacts things.
This isn't advice by any means, because your situation is going to be unique, but let's just take a conservative example. Somebody wants to put 20% down, gets a 7.5% mortgage. That's if you have great credit right now. And
30-year mortgage, right?
Yeah, 30-year mortgage.
Okay.
So you'd be paying $2,300 a month on that home.
Right.
To maintain a decent percentage of your income as housing expenses, let's say 25% or so, that person needs to make over $110,000 a year.
Right. And so that is pushing up what the median household income needs to be able to qualify for that mortgage purchase. Right. So folks, you probably need to make sure as you're enjoying your summer, you need to take action. We're always here to help you navigate that world of financial planning. And we encourage you to look at your statements, talk to a professional if you don't already work with one. If you work with us, give us a call. We'll talk to you about that so we can give you personal advice on your own portfolio. What does all the market volatility and the Federal Reserve rate hikes mean for you? Well, it's going to depend on how things shake out. And there's still a lot of warning signs. There's still a lot of unanswered questions that will just take time. And we're here to help you navigate those things. If you've never talked with us before, you want to make sure that you reach out to us and we can actually have a consultation for no cost at all to try to help guide you during these times. But I want to remember that you can send us an email at info@clearvistafinancial.com. You can also send us a text. I didn't put it on this last slide at 254-282-0495, 254-282-0495. And as always, we can't cover everything in these webinars.
No,
we can't cover everything in the short time that we have. But if you want to follow up and talk in further depth about any particular topic, just let us know. We're happy to help you. And thank you so much for joining us today on the program. Thanks so much. Have a great week.